Hello students, welcome to day 19 of Mathematical Theory of Interest course. In today's lecture, we will continue our discussion where we have stopped yesterday. Yesterday in day 18 we were discussing about the different kinds of financial markets. We differentiated money market and capital market in detail. We have discussed many features of the money market and the capital market. Today we will move further. We discuss what is financial market. It links borrowers and dealers and determine the interest rates, stock prices, bond prices. There are two main instruments in a financial market: bonds and the stocks. Bonds, bond is basically a promise by the bond issuer to pay some specific amount of money in the future in exchange for some payment today. And the stocks or equity securities, basically they give a legal right of ownership in an incorporated firm. It promises the stockholder as a share of the corporate profits, which is called the dividend. The bond market, basically these are the common features that are important terminologies related to bond market. We discussed before in detail. First of all, maturity date. Second one is the corporate rate, yield to maturity, and the bond prices. So I will quickly move on. The bond market, for example, a 20-year bond with a maturity value of $1,000 and coupon rate of 5% promises. What is meant by this type of bond? It gives the investor 5% interest for 20 years. How we can calculate the 5%? 5% of 1,000. It means 20 annual payments of $50 will be paid by the issuer to the investor, and $1,000 will be paid at the end of the maturity time period. It means the investor in this bond will receive two kinds of payments. First of all, annual interest payments and the face value at the end of maturity time period. If the issuing price of the bond is exactly $1,000, it means the bond is issued at par value. Par value means face value. How we can calculate the present value of a bond? Mathematically speaking, because two kinds of cash flows are involved in this kind of investment. One is the annual equal payments for a specific time period, and second one is the face value at the end of the period. So we can easily calculate the present value or today's value of a particular bond by discounting all these cash flows at today's time period. So for that purpose, we can use the annuity method, ordinary annuity method, and the compound discount method to calculate the value of a bond. For example, in the previous example, if we have deposited $100 today at a 10% interest, that will grow every year. So at the end of first year, it will become 100 into 1.1. Second year, 100 into 1.1 raised by 2, similar 3 years, and so on. So the future value of the bond this will be the formula to calculate the future value of the bond. And if we rearrange this one, we can get the dollar value today. Dollar X will be equal to future value divided by 1 plus R raised by T. This will be the formula to calculate the value of bond today. For example, if you deposit $1,000 in your account today and it earns 6% interest, what will be your account balance in 5 years? So this is very simple formula. This is very simple question. We have discussed previously in detail in time value of money topic. So you can calculate the value of that $100 easily. Now moving further, here is another example for 15 year at the rate of 6%. So in the bond market, basically we are supposed to calculate the yield on that bond. Yield is the actual return that we can earn by investing in that particular security. Yield on bond is the same as the internal rate of return we have already calculated previously. To calculate yield to maturity, we define the net present value at which it is the rate of interest at which net present value becomes zero. The yield to maturity is the interest rate that makes the net present value on the bond purchases zero. So if this is how we can take our decision. If the present value is equal to maturity value, it means the par value, and yield will be equal to CR. CR is the coupon rate. If the present value is greater than the maturity value, then it is above the par value. It means yield will be lesser than the coupon rate. Coupon rate will be high. If the price is lesser, then the coupon rate will be lesser. So in this question, if the price of the bond rises, interest rate falls. Is it true or false? If the interest rate is increasing or decreasing, if the interest rate decreases, then the bond value will increase. Bond value will increase because value is calculated by discounting the future cash flows. So this is true statement. Here is another example. You can just carry on this, go through this example by yourself and calculate the value of the bond by taking in mind the concept of net present value and the discounting and compounding methods that we discussed previously. How we can calculate the value, value or yield of a zero coupon bond? With zero coupon bond, no interest payments are being made between sales of the bond and its maturity. That is, there is a zero coupon rate. For such bond, yield calculation is very simple. We can calculate the present value of the future cash flows and subtract it with the price that we have paid. That will be our net present value. And we can easily calculate the yield by rearranging. We can easily calculate this by rearranging the above formula, and the yield will be equal to maturity value divided by price raised per 1 divided by T minus 1. For example, if you buy a zero coupon bond today for $1,000 and it has a maturity time of 10 years and it will give you $1,500 at the end of 10 years. It means bonds are issued at discount. So we already discussed that zero coupon bonds are always issued at discount. That is actually the motivation factor that will attract new investors to buy the zero coupon bond. So if we want to calculate the yield on that bond, we will use the above formula. After using the above formula and simplifying, finally we have 4.14% yield to maturity on this zero coupon bond. Now here is another example. You just practice this question by yourself. I will leave this question for you to practice it. The bond market, it basically decide about how much inflation factor can be adjusted in while calculating the value of a particular bond. Higher expected inflation will drive up yield, and high risk bond must offer high yields. And by mean terms, mean to say that the time to maturity. Yield curve actually it tells us how the yield of a bond move on according to the time period. It shows the relationship between yield and the time term on the government bonds. And the slope of the yield curve will reflect the expectations of the future short-term interest rate and the greater risk of the long-term bonds. In short, the interest rates are expected to be constant. Interest rates are expected to be constant in future, and yield curve will slope upward, reflecting the risk premium for longer-term bonds. Risk premium for longer-term bonds. A steepening of the yield curve suggests the financial markets believe short-term interest rate will be rising in the future. Next one is the stock market. In stock market, the equity securities are being traded, and equity securities give legal right of ownership in an incorporated firm, and these are basically it promises the shareholder to share a share of the corporate profits, to give a share in the corporation's profits. We call it as a dividend. So earning or a return from equity securities will be the dividends. This is how we can calculate the price of a stock by discounting all future dividends, at the given interest rate. It gives us the fundamental value or the present value of this particular stock. The fundamental value theory, according to fundamental value theory, the stock price will rise with three different factors. The price will rise if the interest rate is low. The price of the stock will rise when the expected future dividends will increase, and with the decrease in the tax rate on dividend, the value of the stock will decrease. Now, what is efficient market hypothesis? An efficient market hypothesis: all stock prices represent their fundamental value at each point in time. When new information arrives about a stock, its price immediately adjusts to reflect that new information. It is impossible to consistently predict which way a stock price will move in the future. To consistently, it means to beat the market is very difficult or is impossible. If the efficient market hypothesis is true, what is going to happen? If the efficient market hypothesis is true, then normally the financial advisors can assist you only in evaluating the risk and tax consequences of different stocks and concerns regarding the income or growth. While the financial advisors, they will not be able to consistently find stocks that will beat the market. The validity of the efficient market hypothesis is basically confusing or controversial among the economists. Stock markets, basically, these are the important terminologies which can be used in the stock market, just like the stock quotes, price earning ratio, volume change, 52-week high and low prices, beta, which actually measure the stock movement relative to the market. Mutual funds is basically referred to when a firm that pools money from many small investors to buy and manage a portfolio of assets and pays the earnings back to the investors. This kind of company is called the mutual fund company. It takes smaller investments from different kinds of investors, and they purchase shares of other companies with this amount and generate returns. Among these returns, they will pay back to the investors. Here are some examples of the different mutual funds available. For example, index funds, S&P 500 and Wilshire 5000. International fund, invest in the foreign securities. Bond funds, balance funds, sector funds, growth funds. These are different kinds of funds. The major advantage of the mutual funds is the diversification. According to the pool of because the investment is done in a larger pool, so we can minimize the risk of loss. by investing in mutual funds. Here's a question for you. A stock with high expected earnings growth is likely to have, if a stock or if a share or equity has very high expected future earnings are very high. It means what is gonna happen with the price earning ratio and the beta? It will generate a high PE ratio. It will generate whether it is a low earning ratio or high beta or lower beta. I will leave this question for you. Just a home activity. You can just search out. What will be true in that condition when a stock with high expected earnings growth that is likely to have. Here is another question. This is also a practice question for you. If you bought that stock market was going to rise sharply over the next 6 months, stock with a dash should especially attractive, with a high price earning or with a lower price earning or a high beta or a lower beta. What kind of stock would you prefer? In case the stock market is going to be very sharp in the next 6 months, what will be your answer? Just think over that. Options are contracts in which the terms of the contract are standardized and give the buyer the right but not the obligation to buy or sell a particular asset at a fixed price for a specific time period in time. So basically, options are those financial assets or those contracts in which it gives a right to the holder of this option contract to either buy or sell in a specific future time period. It is called the option. So options market, basically options, we have two kinds of options: call options and put options. Call options refers to the right to buy a particular security in future, and put option is right to sell a particular security in future. Right to sell a particular security in future is called as put option. This is the put option. This is the example of the put option from the IBM. Now here is another question for you. You just think over this question. Just explore this question. Another question for your exercise. This is another exercise question for you. Next come is the future market. Future market is a market where financial assets are being agreed to be traded in future time period. A market for contracts that provide for future delivery of a good at some pre-specified price. Future market exists for commodities, bonds, and foreign securities. So if the expected price of a commodity in the future rises, the future price will also rise. Here is another question for your understanding. You just go through this question by yourself. Here is another question with example. Just think over that. So this is all about our today's discussion. I hope you have enjoyed the discussion. If you have any question, you can ask me anytime. Thank you so much. Bye bye.